Hello, welcome back once again. We have reached 500 subscribers right now, more than that actually, as I'm making this video. And I have to thank you for being around and becoming one. If you are not a subscriber already, you may want to become one because that will help us in reaching 1,000 subscribers, which is the next milestone. For you that are here, thank you for being around, and I have to ask you to like this video if you enjoyed this kind of content, because that really helps bring the content to more people. I will be making a lot more videos in the upcoming days. There's a lot going in the stock market, but today we're gonna be talking about PayPal. And this is a company that I have been asked about. I have made a video about it in the past, but it's been a while, and there has been all sorts of movements around in the stock market, and so it requires a little bit of an update here, doesn't it? And we're gonna be taking a look at PayPal as usual, examine the company, see the current downtrend that it is in, and examine the financials, and also take a look at the DCF model, the discounted cash flow model, and see whether we are now at a price that is a potential buy. I still remember that it was much higher when I made my last video, and so now, being less than 100, it may actually present an interesting opportunity. Let's take a look. First things first, we're going to take a look at the outstanding shares here, being at 1.2 billion almost. And the company seems to be actually buying back shares here, thinking that their stock is undervalued, and that actually helps investors because they're getting their stocks actually are getting more value because there is less currently trading in the market after the company actually buys back shares. So that's a good thing. And you will see that the company's stock price has been down almost 62% here, which is absolutely insane for a company like PayPal, of course. But as we have said in the past, companies that are overvalued at some point come to their senses, and investors tend to, to bring them to their normal valuation. And this is what's happening in the market right now with all sorts of companies. And at some situations, it's actually too much, really, and it's making some of the stocks, some of the companies undervalued rather than fairly valued. And our job is to actually discover these ones. And for PayPal, we're going to be taking a look at the income statement next. And you will see here, as I'm selecting 2017 actually to 2022, you will see here that the revenues of the company are approximately the same. The company has a very similar growth rate in terms of revenue, and that's beneficial for our discounted cash flow model because we can kind of project much more easily this way. And you could kind of expect this from a company that handles payments, I suppose. But the net income here is increasing from 1.8 billion to 4.2 almost here. So that's a good thing to see for the company, although they haven't grown much from 2020 really. The balance sheet of the company, you will see here that the total liabilities of the company are sitting at $54 billion. Now, this is a company that handles payments, and they may have some extra debt leverage, so I wouldn't be too worried about that, but I still want to examine how much free cash flow they are making and compare it to the total liabilities and see how far we are from our generation of cash flow. And the total equity of the company at 22 billion over here, it's pretty fair. And what about the cash flow? Is the company making operating revenue, income? And they are. Cash from operations is sitting at 6.3 billion from 2.5 in 2017. So a nice increase here, almost tripling their operating income here. And the cash from investing, the company is investing in cash acquisitions here. So you will see that they are acquiring some companies, and they're paying back some debt as well, which is interesting. And the other stuff is mostly capital expenditures, expected things. The cash from financing, it's negative again, which is a positive thing for investors because they are, as you can see here, repurchasing common stock. We saw that already. They're buying back shares like crazy here for 4.5 almost billion, 4.4 billion here. That's nothing to sneeze at. That's a lot. So that's good to see. And the free cash flow, it's actually at 5.4 billion here from 1.8 in 2017. Remember, they had liabilities of about 50 billion, and this would take them 10 years of free cash flow to repay if they wanted to pay everything back, which is a little bit too much, but I think that's probably not a big issue for the company really. It's good to know about and good to acknowledge, be knowledgeable about, and actually this can actually play a role in our valuation at the very end. This can actually increase our risk and maybe prompt us to seek more in return, more return on investment in return of that risk. This is how you evaluate companies and how you can actually add some interest on your purchase, potential purchase. If you are to be buying the stock, you can actually think about all these things. The multiples of the company are lower than what they used to be, much lower than 2020, for example. So we're getting a company here that's approaching a valuation that I'd like to see, which is typically less than 3 here. It's still a little bit more than I would like. And the return on equity is 20%, which is very fair, very, very fair here. And what about the solvency? Yeah, I would expect it to be a little bit elevated. It's not as much as I would think, because the company still has quite some equity. So it looks like it's fairly valued here. It's pretty fair here, the debt compared to the equity of the company. So not a big issue that I would think of right now. Now, the next thing that we want to be doing here is we know that the company's value is sitting at almost $97, but is it actually worthwhile purchasing now? I'm gonna be using our exclusive tool here and go to PayPal Holdings. As you'll see, I'm getting a breakdown of the company's revenue, net income, and free cash flow, and I will use these averages here that are basically a very, very concise breakdown of this thing here, of this table. That can help me with my projections, and you will see that the revenue growth has been pretty much the same as we already saw. 18.0 here, 18.26, it's about 18 pretty much. But for my low projections, I'm gonna go lower because I want to be conservative. So I'm gonna go, let's say 13 here, 14 and 15. We're gonna be conservative for revenue growth, generally speaking, and that's a good idea. And you can, of course, always be trying some different values and try 18 as well. Actually, let me try 18 as well, because 18 tends to be the norm here. So I will actually try it. I will actually have it here. And 15 is what I'm going to go with medium. And net income margins is about the same as well, which is nice because we can predict very closely what's going to happen. So let's go 13, 14, and 15 here. Always give it a little bit of a discount. This is our margin of safety here. And the free cash flow margin is great for this company. In case this is not very clear, the free cash flow margin is how much of the company, how much is free cash flow when you compare it to the net income of the company. So it's a division between the free cash flow and the net income. Again here, free cash flow and the net income. And it gives us a ratio, which is the free cash flow margin when compared to the net income of the company. You may be asking, why are we doing it this way? So we do it this way because this way we know that the company is actually profitable, because we are comparing net income to free cash flow, because there are many ways for a company to make free cash flow without making profit, and we want to avoid that. And this is why we're using the net income margin as well. Very important for making sure that we're including profit into our evaluation here and not just free cash flow. Because again, free cash flow you can have from all sorts of ways. For instance, depreciation can add free cash flow. Stock-based compensation can add free cash flow. A lot of things can add free cash flow that it's not real free cash flow. But if you actually factor net income in it as a margin of that, then you know that you are getting free cash flow as a ratio of the company's net income, which is pretty much the profit of the company after all taxes and expenses and everything really are extracted. So the free cash flow margin that we're going to be using here, let's go 110, 120 and 130. And the annual return that I typically aim for is about 13%. And I calculate here, and we are getting that. For our low estimates here, we are still a little bit above what we'd like it to be. We're sitting at $96. Our medium ones are very close though, very close to the current price. And it could potentially be justified just by slightly changing some values here, so we're very close. But for the high ones, which are probably the ones that are going to happen, and they are still not very aggressive, I'd say, we are sitting at $120 here. So this looks like PayPal right now could be a potential interesting purchase for an investor. So myself, I like what I'm seeing here with PayPal. I like it a lot. I mean, I could picture myself getting a little bit of PayPal. Because I'd like to make some extra money from PayPal, I think I'm willing to wait it out a little bit in case it goes lower. And if it goes maybe around $80, which is not too far, especially in the current market, it could happen, 85 or something of that sort, then it becomes a much better value for me and it becomes an interesting entry. It gives me a very nice margin of safety of about 20%. And so if that happens, or maybe 15%, if that happens, then I'm willing to get it. But for somebody who really wants to get some PayPal on their hands, now may be the time, because this kind of valuation here, I can dig it. I mean, it's not the most conservative thing in the world, but it could definitely happen. It can actually pay you the money that you are aiming to get in the next 10 years. This is like a 5-year, of course, evaluation tool here. A period that we evaluate is 5 years for this discounted cash flow model, but it can work similarly. So hopefully that helps you a little bit with your decisions on PayPal. Let me know if you are actually intending to buy PayPal. What do you think about the company? It looks like it's at a very, very nice price point right now. Very, very interesting. But let me know, are you buying? Are you already holding PayPal, or do you think of selling? And where are you with PayPal? And if you did enjoy this video, take a look at this one that I made earlier, and it discusses Facebook and its evaluation. And again, thank you for being around. Please remember to like the video, that really, really helps. And thank you for 500 subs. And I'll see you in the next one. Bye-bye.